Hello everyone, today is Friday, November 18th, 2022. My name is Evan. Welcome back to another edition of Stock Market Weekly, episode 658, where it is our job to break down the most important trends, price action, and noteworthy moves across financial markets. If you're brand new to this video series, first off, thanks for being here. Thanks for joining and clicking on this video. We break up our analysis into two parts. So in part one, we look through the numbers and pick apart everything that stands out and looks notable. And then in part two, we jump into the charts. We take a detailed close at price action and those broad market trends and try and best position ourselves looking ahead. So hopefully that sounds good to you. We're going to jump into today's topics in just a second here, but I do have an update that the format of this series is changing. We are going to go back to the original free for all weekly video series. So about 4 months ago, we started releasing half the videos for free, basically part one of the videos. And then if you wanted to access part two, you had to join a membership or buy a single episode, and that worked well. We had some good interactions with subscribers. I met with a handful one-on-one and sort of just talked through sort of, you know, what kind of traders they were, what they were looking for, what they were getting out of the videos. But after about 3 or 4 months of doing this format, it is more work on our side internally, just because it takes time to produce 2 videos, to get them ready, to get the access correct, et cetera, et cetera. But more importantly, and really primarily, is when we released the Stock Market Weekly membership, we wanted the content to be basically the first bonus, or the first access that you get is just extra content. But the idea was that was the beginning, and we were going to do more routine Q&As, webinars, smaller sort of, you know, get-togethers to kind of keep a pulse on what's happening in the market, and then even open up to you know, forum or a chat group or some type of community where we could interact and exchange ideas together. And that was sort of the plan. But resources are a bit limited. We've got some other projects that we have been working on that are starting to that will be coming out soon. And so because of this, because of really just resources, time, dedication, we cannot move forward with, you know, enhancing the membership. And so it is just going to stay with content for now. And at that point, it didn't make sense for us to charge for membership and have, you know, paying customers on just a content access. So we are going back to our old model. We're going to be releasing the full length videos of our Stock Market Weekly for free for everyone. No more gated access for content. So folks that are, you know, we're waiting for the price action in the second half of the video that didn't want to pay for it. Well, here we are. We're going to be back at it, and we're going to have it out for free. We're going to change things up. We're going to have some different formats and kind of play around with things a little bit, but no more membership content. So hopefully that sounds good. We're going to jump into this week's headlines after a quick announcement here that we also have our long anticipated Black Friday sale. So we basically run one sale a year here at the Trade Risk. It is Black Friday weekend, Thanksgiving week, and it is happening next Monday. Starting next Monday for a week, we are doing a 40% off sale. Pretty much everything, couple of things that aren't included in there, but all the trading systems and the TC2000 store and tools, so on and so forth. Head to that URL, traderisk.com/black-friday, and you can see all of the inventory that is on sale. So hopefully, if you've been waiting and if you've been kind of patiently looking at some of the services and products we have, well, now is going to be your best time starting on Monday. So hopefully everybody can take advantage of that. And now, with a very long preamble, let's get into some of the action here. So first and foremost, bulls trying to keep this momentum intact. It was a mixed week this week, price action wise. We gave back a little bit of ground, but it was pretty choppy and pretty back and forth depending on where you were in the market. Yield curve inversion steepens. So we're seeing some of the most inverted numbers we have seen going back in decades. We're going to talk more about that later. Meanwhile, we have the volatility regime, which is staying lower. We've got the VIX, for instance, which is staying stubbornly in the low 20s right now, which is something we haven't seen in quite some time. And earnings season and profit estimates, they're still, kind of all over the place, but generally speaking, pretty lousy and declining. And meanwhile, we've got this dollar that is trying to form a higher low, which we're going to spend some time talking about. So let's jump into the numbers here and look at the 1 week numbers. You can see it was, again, mixed week, but mostly negative. S&P 500 down 0.66%, Nasdaq down 1.5%, Russell down 2%. Look at those international stocks, so world stocks, so ACWX, and obviously, there are many different ETFs that you can look at here on the international front, so you can slice and dice this a little bit more granular, but we still get some good outperformance there. I actually don't think this 0.31% is accurate. I need to look at that. I think it did finish down about that much on the week, so this number actually might be slightly incorrect. But if we look at the 1 month change here, we still have world stocks, international stocks minus United States, that have been outperforming on a relative basis, and that is still true. So keep an eye on that if you are someone who likes to trade outside of the United States. Now, in terms of market trends, we still have a similar setup as to last week. So we are breaking things down into 10 SMA, 50 SMA, 200 SMA, and looking at the state of those moving averages, just as a simple, dirty way to measure trend. We still have short-term trends that are all rising. 50 SMA started to decline again. So if you remember from last week, we started to get some advancing here in the 50 SMA. It's very flat and could lean either direction. So there's kind of that sideways indecisive point at this juncture in the market. But again, to speak to that international outperformance there, you can see that one is rising. Long-term trends still down across the board. Now, if we take a look at volatility environment, this is what we talked about at the top here is the VIX, particularly the VIX in the S&P 500 that measures the S&P 500 is still staying pretty stubborn and sticky lower. So we're in the lower 20s now, 23 in the VIX. It closed down on the week, and it is just continuing to stay pretty heavy. And, I don't want to say bidless, because historically this is still a very high reading. But given the last year or so of trading, and with COVID as well, we've seen VIX and volatility environments that are just much, much higher. And so we're finally starting to come down a little bit. You can notice the Nasdaq volatility, there's definitely a premium here, right? And definitely more fear and protection being purchased in the Nasdaq, which is under 30, but still much higher than the S&P. Same thing with the Russell, up around the upper 20s. Now, a couple of things from some curated charts and ideas shared this week. This one is from The Real Fly. If you're not following him, certainly a hilarious and insightful follow. So he's been around forever. The Real Fly with those underscores here is his Twitter handle. And he shared this chart basically showing that this is the steepest we've seen the 210 spread inverted going back. I think it was decades, but the data kind of trails off here. Certainly eclipses back here in the 06-07 financial crisis, and we continue to march lower here. So this is certainly cause for concern for lots of reasons, and has certainly been very indicative of recessions and just turbulent periods in the market. So this bearishness is basically continuing here as it actually hits new lows this week. We also have a chart here from our friend Charlie Bolello, who we like to steal lots of his ideas. Certainly always give him credit. Compound Finance, great follow, great person. I've met him multiple times in real life at some different conferences, and he's always fun to chat with. But he was sharing this chart here, which is one of the longest streaks ever of bears dominating bulls here in the AAII sentiment poll. So basically, we've got this just long stretch of very bearish, relative positioning, but certainly sentiment towards the market. And we also have from Liz Ann Saunders here. She shared this on Twitter. Another great follow, but the CBOE equity put call ratio spiking to some of the highest levels going all the way back to really the .com or maybe long-term capital management days of fear out there. And again, this is measuring CBOE, put call ratio, and so that's not, it's not representative perfectly, and lots of people are going to dissect this in different ways, but still I think it goes without saying is there is lots of fear, bearishness, pessimism in the market, perhaps rightfully so. However, this is the context where we need to analyze price action within, right? Because this is the backdrop, is a hated market that has lots of either fear or doubt about the future potential of it. And so if this rally can sustain, or if the price momentum continues, then suddenly we have just this interesting setup. We're going to talk more about that in part 2. So back to the numbers. 52-week highs and lows, the first week in many weeks now where we have more new highs than new lows. It's about time, finally, we're there, where more stocks are expanding to the upside than there are expanding to the downside, but it ain't by a whole lot. If you notice here, it's only by about 58 stocks net on the week advanced. So these numbers are still pretty low here. We need to see more expansion in the number of stocks hitting 52-week highs. We're a broken record on this. It's one of our favorite longer term or medium term indicators for market health. And we want to get this into triple digits here on a day-to-day basis. So let's see if bulls can pick up on this momentum next week. Now, in terms of sector performance, here is very defensive tone to the week here. So it was staples, utilities, and healthcare. You don't get any more defensive than that. Those were the only 3 sectors in the green by about 1.5%. And on the downside, it was consumer discretionary, it was real estate, and it was energy, leading on the downside there by about 1 to 2% as well. Now, IBD industry rank, so we always like to get a little bit deeper than the sector analysis here, and IBD is a great partner of the show. You can support the show, support IBD by using this partner link right in here if you want to get access to these data tables. This is one data table, but there's dozens that they post, and so these get updated every day and after the close, and it shows just basically where the strength of the market is. And right now you can see, again, still highly dominated by energy for the most part, but notice we are getting more retail in here. So retail department stores, retail restaurants are creeping on in, and they were much lower ranked industries just 3 weeks ago. So we're definitely seeing some improvement here in terms of some of maybe the more, I guess hard to say if it's cyclical, but feels cyclical, or maybe a little blend of a staple cyclical consumer type names that are showing up. Now, 10-day correlations, these are getting bright red and bright green again. So basically the market moving in lockstep, risk on, risk off. We're getting the strong inverse correlation here to what the dollar is doing and the 10-year yields are doing. This isn't anything new. This has basically been the theme of 2022. However, we have noticed that some of these correlations started to break down over the past couple of weeks. They seem like they're, starting to, intensify or align themselves once again. So we're going to keep an eye on it. Remember, these are 10-day correlations, so they are pretty short term. Now, Treasury yields, these were pretty mixed this week. In fact, the story, I think, was the long end of the curve. The 30-year was really what was moving down pretty sharply this week. So below 4% once again now for the 30-year. Notice that is below basically the 5-year, which is at 4%. So pretty, again, just speaking to the inversion here going on 5s and 30s. But the shorter end, or in the medium term, is flat to up slightly. Okay, so we didn't get the full kind of across the curve sell-off in yields again this week, but some stabilization there, and it was really that TLT, the long end, that continues to fall. Now, in terms of the US dollar and different commodities here, we had natural gas at the top of the list, up 7% this week. We had Bitcoin rebounding, or at least maybe, I guess, stabilizing this week a bit, 2% to the upside. Dollar index was higher, so finally, or I shouldn't say finally, because it was a very fast sell-off, but rebounding after some extreme oversold and some extreme selling days there in the dollar over the past week or two, is trying to hold its ground. Everything else here, it was down, with crude oil and copper being the big losers here, 7% lower. Now, our current positioning here in the trade risk systems, very conservative, sort of defensive, and just flat. Very disinterested and kind of waiting for the market to just give us better clarity here. Our longer term system Merlin is 19% invested, but a lot of that exposure is basically in dollars. So there's not really that much excitement there. That's not a bunch of small cap stocks or anything like that. It is basically all cash. Our shorter term system is, again, marginally net short this market. And so again, not a big bold stance, mostly cash. And then the trade risk index, which is basically the blend of the two, just again, marginally on the upside there. So that is our current positioning. We've got dollar trials available, but we also have our Black Friday sale starting next week. So again, you can pick up these systems at a deep discount for a week only. That's the only time we do these sales. And these are robust rules-based systems. So check them out on our website if this interests you. And with that, we'll be back here in just a moment with part 2. All right, we are back here with part 2. I am a little pressed for time right now, recording this a little bit later than usual, so we might move through a little bit quicker here, but let's get into it. This is the S&P 500 cash settled market weekly time frame, and this is the roadmap that we've been using for basically, feels like all of this year, but certainly the last 5-6 months or so, keeping it very simple with these horizontal supply demand inflection point areas that have been pretty influential in the market, and trying to just keep things as simple as possible throughout all this volatility. And so, well, let's go back to that weekly chart. So the big breakout was last week. This was where we took notice here when we finally started breaking above this 3,900 zone. This was 3-week highs, but this also got us back over some of the ranges here from May, June, July, and then where we, in fact, broke down from in September as well. So this 3,900 zone has been pretty influential and key psychological area for the market. We broke above it last week. We did it with a gap up, if you recall. So it was a very much gap and go breakaway sort of session, where the S&P 500 is up 5.54%, and the Nasdaq was up, at pretty record levels as well. And so basically what has occurred here since our video last Friday was a lot of chop and a lot of pullback and some really back end filling in here back towards the 3,900 zone. So really, when we look at this week, no, we did not get, superb momentum, follow through, extension, and just complete FOMO to the upside. We got a more sort of realistic, maybe reasonable market where we chopped around sideways, frustrated maybe the majority of folks, got some, folks that caught this move to take some profit, got some short sellers to kind of come in here and, initiate new shorts up over 3,900. And it led to basically a little bit of sideways, a pullback, and so far a hold over 3,900. We popped up and closed, towards the top end of the range on Friday, going into the weekend, going into the holiday week. So the way I look at this market, again, keeping in mind the context of everything from part 1, the sentiment that is bearish, a hated market, maybe for rightful reasons, but a market that is currently in a short-term uptrend. And so as long as we are above 3,900 here, I am still giving the benefit of the doubt to the buyers right now. The short-term trend is at the buyer's favor. And if you want to give things a little more room, then you have this breakaway gap in here, right? So whether or not you want to pick your poison at 3,900 as your line in the sand, or if you want to come down closer to 3,800 and say, well, I'd love to see this gap stay intact, or, I'll play for a defend of the gap fill, something like that to manage risk and to basically stick with this trend. But if we start losing 3,900, if we start filling this gap, and if we start rolling over here, then, it's pretty clear that the bulls are starting to, lose this trend, lose enough momentum. And then, yes, it is time to get defensive and protect ourselves for what could potentially be a move back down to the October lows or worse, new lows, right? But until and if that happens, I want to just favor where the evidence is at this time, and that is still higher. So right now, that is my disposition. That is my leaning here. And until one of these support areas are broken, that's kind of the game plan I'm sticking with. And you know, until and if that happens, my belief is still that we can get back up here into around the 4100 zone. We can fill this open gap here from September, and we can go and challenge some of these overhead supply levels where the market has failed and based sideways at earlier this year. So to me, I think, you know, even right now, the reward to risk is looking kind of interesting because stopping out below 3,900, targeting 4,100. I mean, that gets you a good 2.5 to 1 reward to risk if you like this setup. And again, this is just the plain vanilla S&P 500. You can go down to sectors and, you know, really go for a more targeted sort of allocation or trade. So that's the way I'm looking at things. Kind of hasn't changed that much. I was pretty bullish last week and remain the same this week, provided all of those technicals hold up. Now, again, Russell 2000, we've got very similar situations here across all the markets. Russell 2000, I don't know, is probably the least interesting to me. It has just a more heavier supply over here in this 190 band. And, you know, this was kind of a weaker give back this week. It basically, you know, started to fill some of this gap, but the open gap stayed defended. But overall, you know, again, you've got to appreciate the fact that we're 13% off the lows, but it just doesn't look as, you know, interesting or actionable to me right now. The Nasdaq 100 is, you know, again, probably has the most potential upside, but still maybe some of the most risk associated with it. So the Nasdaq 100 is just holding above the 1 month highs here going back to the start of October. So this is where the market, you know, kind of pushed up in early October, it failed, pushed up in late October, it failed. And then, you know, it broke out just last week. And now it's kind of just, you know, hanging right in here. This big gap is still open. And, you know, we have certainly a lot of room and some open gaps from earlier in the year up here. If the Nasdaq can get its act together, this probably has, again, like I say, the most juice to the upside, but it is also one of the weaker relative strength plays here over the past couple of months. So I think a lot of this is going to sort of be dictated partly by TLT performance, or I think these two things certainly go hand in hand. We've been watching interest rates, volatility, and the dollar, right? Those are the three things driving action. And frankly, you could probably boil it all down to the dollar. But TLT here has been making, you know, headway. It broke this long downtrend that has been in place since early August, and it is kind of holding up here, right? And it has entered this short-term uptrend. So again, I think if TLT can stay bid, if TLT can stay in an uptrend, then you probably get your more bang for your buck out of the Qs. Okay, so that's kind of the read-in that I would take there. Now, as we move to other markets, we look at the US dollar here. So the last 2 weeks were brutal, or really it was last week. That was brutal for the US dollar index, one of the worst performances on a weekly basis, frankly, ever, or certainly in the top percentile. It's down 4%. And extremely oversold in that short-term reading. Again, breaking the multi-month, year-long uptrend that has been in place. And so we are now starting to bounce here. And I think this is just going to be an interesting tell on how much, you know, how much legs can the dollar get here, right? Does it, you know, get a couple of days up into the, you know, 2930s or so and then roll back over? If so, that's going to be great for stocks as a tailwind. But if this thing bounces aggressively here and just gets bid and reclaims this trend line, then I would venture to guess that stocks are going to start to get slammed again as the US dollar turns into that wrecking ball. So I think watching UUP, watching TLT, these are some other intermarket, but very important markets we can get some sort of clues from next week. Last but not least, if we look at VIX, well, VIX here, again, like I say, is bullish in the sense of it is staying stubbornly kind of heavy down here in the lower 20s. Seems like it's got a magnet back down towards maybe the August lows. So if you recall, August got all the way down to a teens, 19. And right now the VIX looks pretty heavy and just kind of wants to settle in on these lower 20s, especially as we go into holiday time, maybe a little bit sleepier trading. maybe lots of funds that are trying to chase performance or mark up their books, or just try and get a nice bullish bid here into the next couple of week window that would help support the VIX case to stay low and equity markets staying bid. But we shall see, right? We're going to keep a pulse on this week by week, day by day, frankly, and just make sure that the technicals, the price action is holding up. But like we say, we've got a nice backdrop. We've got a hated market that has entered a short-term uptrend. Let's see how much it can continue. So we're going to end it there. I got to run, but hopefully this was helpful. Hopefully you had a good week of trading. And as we get ready for the next week, remember we've got day and a half markets are going to be closed for the Thanksgiving US holiday. And don't forget, next week we are running that Black Friday sale. So go check out our trading systems. If you had a tough year, see if one of our systems is a good fit for your personality. Maybe it can help you into 2023. So that is it for me. Thanks as always for tuning in, and we'll see you back here next week.